The public market debut of SpaceX on June 12, 2026, was a historic event, seeing the stock surge past $200 per share and pushing the total valuation toward $2.65 trillion. While observers initially attributed this to a retail-driven meme rally, the actual drivers are far more technical. This presentation provides a structural roadmap of the SpaceX IPO lifecycle, detailing how financial engineering, index inclusion rules, and a precisely timed supply calendar are currently shaping the stock's trajectory. We will explore how the initial period of artificial scarcity gives way to an engineered liquidity handoff by late August. A central mechanic of the SpaceX IPO is the microscopic public float. SpaceX offered only 4.2% of its total shares, consisting of roughly 555 million Class A shares. At a price of $180, this creates a tradable public pool of approximately $100 billion. It is vital to distinguish this figure from the company's total $2.36 trillion market capitalization, which includes billions of locked supervoting shares and other non-public tranches. This constraint means that less than 5% of the total company is available for trade, creating an extreme liquidity bottleneck that amplifies the impact of mandatory institutional buying. The first major wave of mandated buying comes from FTSE Russell. Under a new fast entry rule, any IPO with a market cap above $17.5 billion is eligible for index inclusion after just 5 trading days. SpaceX met these requirements on June 18. The effective inclusion date is June 26, meaning funds tracking the Russell 1000 and Russell Top 200 must purchase SpaceX shares by that date. This mechanical wave is expected to trigger between $10 billion and $16 billion in forced buying, creating an early demand floor before the broader market enters the larger July squeeze window. Shortly after the Russell wave, SpaceX becomes eligible for MSCI US and MSCI World indices around June 29. MSCI admits qualifying IPOs after 10 trading days. Although SpaceX's float-adjusted weighting within these indices is relatively small, the sheer size of the global asset pool tracking MSCI, estimated at over $15 trillion, ensures a secondary layer of automated accumulation. This wave reinforces the institutional buying pressure, continuing to squeeze the sub-5% float as global passive portfolios begin to establish their mandatory positions ahead of the midsummer peak. The technical focal point occurs on July 2 during the Nasdaq 100 rebalance. Due to a new methodology allowing top 40 ranked companies fast-track entry in 15 days, and a weighting multiplier that can reach 3x for low-float stocks, passive trackers like QQQ are legally forced to buy an outsized portion of SpaceX stock. This squeeze is intensified by an early close on July 2 at 1 p.m. Eastern Time. Passive algorithms must execute between $15 billion and $27 billion in rebalances in just 3.5 hours, creating a high-velocity mechanical demand vortex. To accurately project the 2026 landscape, we must aggregate the verified index flows. The combination of Russell, MSCI, and Nasdaq 100 forced buying is projected to drive between $25 billion and $47 billion in passive inflows through the end of the year. Notably, the S&P 500 is not a near-term factor. S&P Global rejected a profitability waiver in June, confirming that SpaceX must achieve 4 quarters of GAAP profitability before consideration. This means the current demand is entirely driven by the fast-track rules of the Russell, MSCI, and Nasdaq families. The artificial scarcity engineered into June and July transitions into a supply shock in late August. This is driven by a staggered early release lockup schedule for employees and venture backers. The underwriters structured a conditional escape valve that triggers following the release of the first public Q2 earnings report. Because the stock has maintained a price 30% above its $135 IPO subscription level, a performance-based clause is activated, bumping the initial unlock from 20% to 30% of the eligible pool. When the late August trigger fires, it injects approximately 1.41 billion new shares into the circulating tape. At current prices, this represents a $253.8 billion increase in tradable supply. This shift scales the circulating public float from its initial 4.2% to roughly 15%, significantly altering the market dynamics. This handoff allows early insiders to cash out into the massive pool of buying liquidity generated by the passive index funds in the preceding weeks, marking the end of the artificial scarcity period. As supply expands, the market will shift focus to fundamental anchors, primarily the Neocloud strategy. SpaceX has secured significant contracts to offset capital expenditures, including a $1.25 billion per month deal with Anthropic through 2029 and a $920 million per month agreement with Google starting in October 2026. Together, these Neocloud contracts generate over $2 billion in monthly revenue. However, investors must note that both agreements carry 90-day mutual termination clauses, adding a layer of fundamental volatility as the technical index squeeze gives way to earnings-based performance. The life cycle of the SpaceX trade is dictated by this rigid, rolling calendar. We move from the mechanical peak of the Nasdaq 100 squeeze on July 2 to a massive structural supply unlock in late August. By December 8, the traditional 180-day lockup cliff expires, fully removing supply restrictions. Understanding this roadmap is essential. The early volatility is driven by the technical index trap created by passive fund mandates, while the long-term trajectory will be defined by the company's ability to justify its valuation as its circulating supply finally scales to market norms. For detailed discussions and references, watch the YouTube video The SpaceX Squeeze and the expiration dates.